Good afternoon, everyone. Thank you for joining this webinar, Spotlight ETFs of the Month. This is a monthly series which we do where we talk about in the current market conditions, which are the ETFs or market segments which are making sense from an investment point of view, right? So today we'll talk about a couple of smart beta ETFs, namely Alpha 30 and mid and small cap momentum quality. These are the two products we have been talking about since quite a while, and I think they still make a lot of sense if you're willing to hold them for a longer period of time. The current dips provide reasonable opportunity. Then I'm going to talk about a very unique product, which is new age consumption, because we feel that right now, if you look at things which are happening at the policy level, it is going to drive consumption this probably by the fag end of this year or the next year, and consumption is one space which we like right now. Then I'm going to talk about multi-cap because there are a lot of people who wants to basically take a very core exposure in the market, and I think a multi-cap strategy is probably my favorite strategy right now if you want to invest in the market. For the core portfolio. And then we're going to talk about silver is probably right now being talked about a lot, finally after a long time, right? It was sorts of outglittered by gold for quite some time, but finally we are seeing some movement in silver, which we were expecting since some time. So, without any further delay, let me first give you a very brief recap of what is happening in the market, and this we do in our webinars every time. So, so I'm getting a comment that my video is not visible. Let me just quickly try it again. Just a moment. Yeah, I hope things are visible now. Yeah. So if we do a quick recap, last 1 month has been sort of pretty flattish in terms of market performance, right? We saw some corrections in on Friday itself. So Nifty and Sensex were very flat in last 1 month. This is last Friday ending data. So you have Nifty and Sensex rising less than 1%. But then we have seen now sorts of some bit of recovery in next 50, which fell quite a lot. So next 50 is up by 3% in last 1 month, and last 3 months it is up by almost 14%. Having said that, it is still down by almost 13.5% from its 52-week high, which you can see here. Large cap, which is Nifty and Sensex, is only down 5% from its all-time high, whereas next 50, which is the 50 worst to 100 rank stock, is still 14%, around 13.5, 14% down from its 52-week high, which is very stark, right? One large cap segment recovered quite quickly. The next 50, while it has recovered, right? If you look at 3 month return, it has given returns more than Nifty 50 and Sensex, but it fell also more. So it is still down almost 13.5% from its 52-week high. Mid cap, again, good 1 month, 5.3%, and small cap 8.9%. And surprisingly, both small cap and mid cap are down only 4% and 7% from its 52-week high. So large cap has recovered quite a lot. Mid cap has recovered quite a lot. Small cap is just down 7.7% from its 52-week high. So a segment, if I'm looking at a market cap level, it's the next 50 is only a laggard right now, which is still trading at a reasonable price correction of almost 13.4%. Again, at sectoral level, if you look at financial services, banks pretty flat. Uh, just very positive around just 1% or so, but very good rally in PSU Bank. So PSU Bank is now up 7.4% in last 1 month. In last 3 months, almost 22%. So in last 3 months or so, it is outperforming the remaining financial services segment. Uh, Again, from 52-week high, financial services index is just 2% down. So bank as a whole and financial services as a whole is trading around 52 weeks high. So that is also one very important thing, that financial services never fell so much, because from a valuation point of view, there was always some amount of comfort. Even now, if you look at valuation, that is one segment which is available at a reasonable valuations. uh, uh, and From 52-week high, it is not so much down. PSU is down around 8%, but looking at the rally right now in last 3 months, 22% up, so it has also recovered quite a bit. Looking at energy commodities, oil and gas. Again, pretty flat month. Energy up by 3.5%, but commodities 1.2%, oil and gas 2.2%, utilities 0.7%, power 1.8%. This segment, if you look, is highlighted in red when you are looking at a 52-week column, because these segments are still substantially down from its 52-week high. So you're looking at utilities down around 23%, power down around 23%, energy index itself down 20% or so from its 52-week high. So this is one segment which has not done well, and probably that also explain why next 50 has not done really well, because there is reasonable amount of contribution also from these segments in next 50 index. Metal up by 5.3%. If you look at capital goods, 6.1%, obviously driven by defense segment. One segment which has not done well is FMCG and consumer durables, which is down almost 2.5% in last 1 month, and still trading at 17 to 16% lower than its 52-week high. Media is has gone up by 7%, but again around 20% lower than its 52-week high. Reality gave us a great return of around 16%, and that is why now it is only 12% down from its 52-week high. Looking at IT, reasonably okay month, 3.6%. It's down around 15% from its 52-week high. So if you're looking from a segment point of view, right, because people, to be honest, are looking at price correction, taking advantage of dips to invest in the market. And if you look at segments, it looks like uh, consumption is one space. Look at auto around 16.6%. So consumption is one space, and energy commodities are one space where you can still see a reasonable price correction from it, from the 52-week high. Looking at Alpha 30, which is a momentum index, it gave 4% return in last 1 month, which is good. 3% in last 3 months, almost 20% return, which just highlights the fact that alpha and momentum strategies correct a lot, right? When the market phases are changing, when there is a sort of a bearish phase of the market, but it can recover quickly also, which just highlights how quickly in last 3 months Alpha 30 has recovered, giving a return of almost 19.5%. It is still 15.5% down from its 52-week high. Volatility index, which captures less volatile companies, in last 3 months has given a return of 9.8%. Now it is down only 8.7% from its from its 52-week high. Again, from a valuation point of view, like I mentioned earlier, most of the segments are trading at trading at premium. Uh, from a sector allocation, if you look at sector per se, just then it is only financial services which are available at some discount, but other segments are still sorts of trading at premium. Now even large cap at 21.5 PE, uh, and if you look at other segments also are trading at a are trading at valuations which are higher than their historical long-term averages. Now, next slide, we'll basically talk about international market. FANG has given 4% and 20% return in last 1 3 month respectively. Phenomenal run continues. It is trading around its all-time high right now. At a PE of around 35.4. If you look at Nasdaq, has given return of almost 2%, 12.7% last 3 months. So the entire euphoria in tech is continuing, and then I think there is a lot of sorts of reasons behind this, and the most important one is that if you look at earnings, especially the earnings which came out of tech segment in US has been really strong. So people are seeing strength in the AI story, strength in semiconductors, strength in corporate earnings, and then that is why we are continuing to see a lot of performance, reasonable performance from companies continue. Again, S&P 500, S&P 500 top 50 uh, performing occasionally around giving around 1 2% return. If you're looking at Hang Seng index, which is a broader index like Nifty 50, it gave a return of 4.4%. But Hang Seng Tech, I think, just borderline negative, pretty flat month last year. So it's now 14% lower than its 52-week high. Now looking very quickly at gold. Now gold right now is trading around MCX spot. This is around 98,800. 1 year return absolutely high at almost 38%. So gold is at all time around all time high. So is silver, right? We are looking at silver around 1 lakh plus now. Last 1 month return has been very good at 12.3%. So now silver is sorts of uh, doing well, catching up, and I think a lot of market since last 3 6 months we have been expecting silver to do well, but that I will sort of cover in one of the couple of slides which I have about silver. Dollar index, we have talked quite a lot on that. That seems like the Trump government is comfortable with dollar index below 100, and dollar index right now is around 98, with 52-week high being 110. The USD INR 86 compared to its 52-week high of 87.58, so almost 1.5 rupees down from its 52-week high. Uh, Obviously, the crude now has shot up dramatically because of obviously escalations in Middle East, the Israel-Iran conflict. So that is one space which is going to influence not only crude but other uh, segments as well. This is a brief sorts of, again, in every presentation I just put out a slide which talks about all the products which we have on domestic side, on smart beta side, on theme side. So we're managing right now 51 products. We have ETFs, fund of fund, and index fund. Fund of fund with similar taxation as equities, similar to ETFs and index funds, now are also very good options to take exposure in products where we don't have index fund, but you can take exposure via fund of fund. Now let's talk about first product, which again I'm going to talk about, and this is uh, for taking core exposure, right? Uh, See, markets are back at higher valuations which you're talking concerned about September and October last year, right? We saw very significant corrections in the first quarter of this year, and then market has seen recovery. A lot of that is obviously driven by liquidity, which we are seeing in the market, right? So again, what how should investor approach investments in this market? So one way is to look at products, a diversified product. I'm just talking about from equity point of view. So two products which you can look on the passive side. One is multi cap, right? And multi cap is basically uh, it takes 50% exposure in large cap, 25% in mid cap, and 25% in small cap. Invest in all 500 companies. So in top 100 companies, it invests 50%. In next 150 mid cap companies, it invests 25%. In 250 small cap companies, it invests 25%. The idea is to own the entire market in a good proportion, right? Because we believe that mid and small cap segments are very important to Indian economy right now. So large cap is a very sorts of small space. It's just 100 stocks. So there are so many companies which are sector leaders. There are so many segments which are underrepresented or not represented at all in large cap space. And to take exposure in those, you have to invest in mid caps, you have to invest in small caps. Just think about capital market segment. To take exposure in capital markets, you have to invest in mid caps and small cap. To take meaningful exposure in industrials, in capital goods, in real estate, etc., you have to take exposure, invest in large and mid cap space. So sorry, mid and small cap space. So multi cap investing right now is sorts of very important and makes a lot of sense, because for next 5 years, as more and more company uh, gets listed, you will see that if you want to participate in Indian economy, if you want to have reasonable representation in all the meaningful sectors, etc., large cap is not going to do the job. Even large and mid cap probably is not going to do the job. You have to look at multi cap exposure. So we have a multi cap ETF. We are the only AMC who have multi cap ETF right now. And obviously, the data illustrates that sector rotation take place, style rotation take place. There are calendar years when one sector performs well. There are calendar years when one factor performs well. Value had underperformed since quite a while, right? From 2012 to 2020, and now in last 2 3 years, value is doing the best. So there's a factor rotation. Then there's a market cap rotation also. Some years small cap does well, some years mid cap does well. So if anyone is looking for a core exposure, multi cap strategies are probably the best way to take it. I think either in passive segment or in active space as well. In this multi cap version, basically you have around 70, around, like I mentioned, around 29-30% exposure to top 20 stocks. So your weightage is also of large cap, like I mentioned, is constrained at 50 uh, percent. This is the performance also, and if you look at performance also, it just listed that in the long term, multi cap will outperform a Nifty 500. Right? I think multi cap will even outperform a total market cap index fund, because if you look at Nifty 500, almost 70-75% exposure will be in large cap, right? Your participation in mid cap and small cap on an aggregate will be 25-30%. But in multi cap, small cap plus mid cap is 50%, 25% each, right? So since the exposure towards mid and small cap is more, since the exposure towards sectors which are doing well, which are rising sectors is more, you will see multi cap strategies doing better plain vanilla Nifty 500, etc. strategies, and the data also represent that. If you look at uh, 2 year, 3 year, 5 year, 7 year return, you'll see multi-cap strategies doing better than Nifty 500. Yes, if there's a market correction, multi-cap will probably correct a bit more. It's a 500 stock portfolio, so diversification is there, but it will probably correct a bit more. But in the long run, uh, it's more likely that multi-cap will outperform the Nifty 500, right? Because of the contribution from mid cap and small cap. Even if you look at rolling return basis, a 7 year or a 5 year rolling return, 500 is around 12.7% multi cap. Again, a very simple product is around 14%. So 1.3% alpha by simply shifting from 500 type of product to a multi-cap product. So I think right now makes a lot of sense to sorts of look at multi-cap as a core exposure. If you don't have a demat account, or if you don't want to invest in ETF, you can look at our total market cap index fund. That's the second best alternative because it captures 750 stocks, which includes 250 micro cap also. But it does that in a market cap weighted manner. So I'm just taking around 70% will be large cap, 3-4% will be micro cap, around 15-20% will be mid cap, and remaining will be small cap. So it takes exposure in the entire 750 stocks. So if you are looking to take uh, uh, core exposure, my first suggestion will be multi cap. If you which has better performance sorts of potential, but may have higher drawdowns, right? Because large and mid cap has higher volatility. But if you are looking for a more stable option, let's say उतना भी risk नहीं चाहिए, then I think total market cap index fund which we have is the second best option, and then it is based on an index fund. So if you like index fund, you can probably look at that. Now, so that was on the core side. Now I'll talk about one theme, right? We came out with manufacturing product quite a while ago. We were the ones who created the India Manufacturing Index, Nifty India Manufacturing Index, which was a very diversified product to take exposure in the length and breadth of manufacturing uh, space, right? And it has done really well. So anyone who wants to look at capital markets, capital goods segment, industrial segment, just have a look at our manufacturing ETF. There's a fund of fund option on it, so you can look at the fund of fund option also. It has done really well. If we are talking about right now, I think consumption is one story which we like a lot, right? We are talking about government because of tax cut trying to put more money in consumer hand. We are talking about new pay commission probably coming in next year. We are talking about RBI cutting rates, cutting CRR. Obviously, that will happen in months to come, with an intent to provide more liquidity to the market. They are thinking about increasing consumption, driving growth, etc. And all that sorts of sets up consumption really well, right? Consumption is like I showed you in the first slide. The segment has corrected quite a bit, right? From 52-week high, we are seeing multiple spaces within consumption trading at 15, 16, 17% discount. So price correction is there, and the future potential is also there. And one space within consumption which we like a lot is discretionary consumption. So because we believe that as per capita GDP rises, as spending behavior of consumer evolves, it has evolved quite a lot in last 5 years post COVID, right? People are spending more on aspirational item, more on discretionary item. If I give somebody gets 10,000, 20,000 extra, he's not going to buy one more Surf Excel, or not going to buy probably FM's one more soap, etc., or an Asian Paint bucket, right? He will go and probably spend it in a restaurant. He'll probably go for a movie. He'll probably, if he gets more, he'll probably go to for a vacation, etc. And that is what we are seeing. People are spending more. Discretionary wallet share has increased in both rural and urban areas, and there is data to back it up. So if you're looking for a thematic investment, uh, then this space, new age consumption, which is discretionary focused fund, makes quite which makes so much sense. We are the only ones in entire industry who has a discretionary segment focused consumption fund, be it be on the passive side or on the active side. It's a 75 stock portfolio. It only captures, just think of, if you have additional money, where are you going to spend it? And it captures all the possible options. You look at autos, consumer services like e-commerce, fintechs, white goods, reality, AMC. You may probably invest also. Stockbroking, you may go ahead and trade also. Telecom services, textile, media, etc. Everything is there. So this is a 75 stock portfolio. Top stock is capped at 5% just to ensure that there is enough diversification. There's not too much dependent on one single stock. And if you look, see, the trend has changed in last 4 or 5 years. If you look performance of 4 or 5 years, that will illustrate all sorts of tag along with what I'm saying. In last 5 years, it has, this product has given, or index has given, around 30% return. 3 years, 24.6% return. Last 2 years, around 33% return. From portfolio point of view, this is the portfolio, right, which I was talking about. Just imagine, again, where are you going to spend or invest that additional money, and this product will sorts of invest in that segment. So you have passenger cars and utilities, right? Two wheelers and four wheelers. Then you have reality segment, right? You have DLF, Macrotech developers, Godrej, etc. Then you have e-commerce and e-retail like Zomato, Nykaa, Swiggy, etc. Then you have telecom service providers, Bharti Airtel, Vodafone, etc. Then you have Titan, Kalyan Jewelers. You have specialty retail like Trent, Vedant Fashion, Aditya Birla Fashion, etc. You have on the consumer electronics, you have Havels, you have Dixon, etc. On the, you have Indigo as an airlines. In household appliances, you have Voltas, Blue Star, Whirlpool, etc. On the fintech side, you have PB Fintech, Paytm. Then you have exposure to hotel and resorts, Indian hotels, lemon tree hotels, etc. Then again, obviously, invest also if you're getting additional money. So you have exposure towards AMCs, SGFC, Nippon, etc. Then you have diversified retail, Avenue Supermart, and then you have exposure towards India Info Edge. Then probably you can again invest via stock broker. Then you have 361 or Wealth, Angel One, Motilal Oswal Financial Services, Nuama Wealth. You can go out, probably eat in a restaurant. Then you have exposure towards Jubilant, Devyani, Westlife, etc. Garment and apparels, tours and travels like IRCTC. Then you have TV broadcasting services, Z, etc. Then you have uh, obviously PVR, Network 18, Bata India. So you have exposure to plethora of sectors and segments where we see discretionary spending happening. So this is again, like I mentioned, a very unique portfolio, one thing which we really like right now. And if you're looking towards thematic investment, this is one space where we sorts of which we suggest right now. Now let's quickly move towards silver, because silver is something which has been talked quite a lot. So I think it is probably well known that silver has been, from a supply point of view, has a supply deficit, right? And that has been since quite a while. So that story sorts of remains the same. What has changed obviously is I feel that probably uh, what we are seeing in China. If the US China trade deal, if we see sorts of export market recovering, if we see the internal consumption, domestic consumption in China improving, that is something which will and which has in a way supported this rally in silver. Recently, the China data came out, which just talks about that there is some bit of, and this is month-to-month data, so probably we need to sorts of see a continuous trend also. Then only we can probably talk about China, whether China has recovered when we talk about domestic consumption. But at least the indications have are slightly positive, right? And that is also one thing which sorts of helps silver, because silver, unlike gold, is dependent a lot on industrial applications also, uh, like solar cells, EVs, etc. So it is dependent on the fact whether these industries are doing well, and these industries have significant base in China. So China obviously influence silver quite substantially. So see, one thing which people should also note is that silver is a very volatile commodity. It is much more volatile than gold, right? So you may have a very different experience when you invest in silver. So always be cautious about that. Don't equate gold and silver, right? For example, if you look from a performance point of view also, gold was down by 4.5%, silver was down by 23.5%. In 2014, gold was down 8%, silver was down 15.9%. In 2021, also gold was down 4%, silver was down 8.5%. In 2008, gold was up 26%, silver was down 7.4%. So it can have a very, very different performance than gold. Yes, in last 1 2 years, both have sorts of given positive returns. That's very good, but they can have a very divergent performance also. If you're looking, let's say, at a 7 year data, silver has given 13.6% return on a CAGR basis, right? But then again, silver, I think, becomes somewhat tactical also at time. Just look at returns from sorts of 2013 was negative, 14 was negative, 15 was negative, etc. So I'm not sorts of uh, scaring anyone to invest in silver. In fact, between silver and gold, right now we are recommending silver, but I'm just sorts of pointing out the fact that silver is more volatile. So it gold should form part of your portfolio, right? It's an essential part of the portfolio. Probably same cannot be said about silver, right? So add on to silver, but don't miss out on gold also. So gold is something sorry, silver is something which you are suggesting right now. If you look at rolling returns also, 5 year rolling return is roughly around 9.2% for silver. So only reason, like I mentioned, that silver is probably looking good right now is obviously the fact that data which is coming out of China looks a bit sorts of promising, right? US China trade deal has has happened in a way, right? Though looking at a levy of almost 55%, it's quite a lot. So we'll have to obviously look at how export market is behaving in China. But like I said, that it is relatively better placed than what it was looking a few months back. Also, gold silver ratio, which you can see in the blue line, right? So uh, the uh, uh, the orange line is gold, right? And you can see this is the gold axis, and this data is in dollar terms. So you can see gold roughly around 3,400, 3,500 levels, right? And silver is in blue line, XAU, XAG currency, and this you can see on this axis around 35, 36 level, right? And something which people tracks a lot is gold and silver ratio, So what does gold silver ratio tells you? That so I did an average, and over a period of time, gold silver ratio is roughly around, I think, 70 or so. Uh, if gold silver ratio is higher, it implies that gold is costlier, silver is cheaper. And if gold and gold silver ratio is lower, it signifies that silver is costlier, gold is cheaper. Right now, gold silver ratio is around 94, so it is at a much higher level than the historical average. So that also sorts of support the entire conversation that gold has run up so much. Uh, now silver, with data from China looking okayish, probably now silver will uh, do well. So this is gold and silver ratio. As you can see, it has gone up, obviously, like I was mentioning, to roughly around 94 right now. But you can see that it has slightly increased, right? Somewhere in 2020, 2021, it was below 80. It was even below 70 at one point in time. So while gold and silver ratio uh, at 94, it looks like gold is obviously expensive than compared to. So this is one price chart which is talked about a lot. So just wanted to sorts of present this data set also. Now, the last segment which I'll cover is gold and silver ratio, and this I'll try to smart beta, and this I'll probably cover in like 10 minutes, and then for last 15 minutes we'll take Q&A. So again, smart beta is something which is doing uh, uh, reasonably okay in the market in terms of recovery. You see good amount of recovery happening in value based strategies and momentum and alpha based strategies. This segment as a whole uh, has become quite popular. I think we are talking so much about smart beta in last 1 2 years. It just highlights that if there's something unique, something which has potential, people do want to know more about it, right? But we have talked about this in almost all of our previous webinars when we have discussed in detail about products. The name itself justify what the intent of the product is, right? For example, smart beta, I personally feel, is a wrong term. It should be factor investing, right? Because smart beta sometimes tries to portray that this strategy is very smart and it will always do well, right? People can think that ways also, but that's not the case. It is just factor investing. It just creates a portfolio based on certain parameters, right? And the parameter is chosen to target a certain behavior, and this product behaves in a manner or seeks to behave in a manner for which it was created. For example, momentum alpha will do well in the bull market and may or may not do well in a bear market. In fact, in most of the times, it will have a higher drawdown. It will correct a lot, and which is as expected, right? If you're trying to chase return, invest in stocks which are doing well. When market correction happen, those are the first names which corrects, and hence you'll see that whenever there's a change in market scenario, change in market phase, change in market cycle, alpha momentum has a higher drawdown, right? But in the long term, because we are living in a country which economically is doing so well, which has seen multi years of bull run, right? Momentum alpha strategy in the long run does well. Uh, Value is all about capturing stocks with lower multiples, right? We all know that value ends up capturing a lot of stocks from segments like energy, metals, capital goods, etc. And it tends to have phases of underperformance and outperformance. It does poorly when there is market correction, like how all cyclical companies does, and it does well when there's a broad market rally. Low volatility, on the other hand, typically consists of stocks which are more stable from a price performance point of view. And as I said that, you'll understand that stability, if I talk about stability, you'll straightforward think of FMCG stocks because they are less volatile, healthcare less volatile, couple of private banks, larger companies like Reliance, etc., which are less volatile. And if you look at the portfolio of a low vol, it will consist of those names. So look at the factors, and if you go a bit deeper, you'll see that they try to target a certain behavior, and because of targeting a certain behavior, the portfolios at time uh, sorts of becomes very uh, biased towards certain factor, or gets tilted towards certain factors, or get tilted towards certain segments. Understand that and then invest if it uh, aligns with your investment objective and risk profile. So why smart beta has become really popular is, over a long term, typically a lot of these strategies have done really well. Alpha and momentum being one thing, right? If you are okay to sorts of bear the pain when markets are correcting, then alpha is one thing which you can look for investment, right? Because yes, there are drawdowns, but in the long run, if you participate in 2 3 good years, you will see alpha doing and momentum strategies doing better than the market. So look at 10-year performance or a 5-year performance. In 10-year, Alpha 30 has given almost 20% return, uh, which is almost 6.5% more than Nifty 200, right? In 15 year, it has given 20% return, which is almost 7% more than the benchmark of Nifty 200. So it does really well in the long term. It does really well when markets are doing good, but it can have higher drawdowns. Uh, 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 Same thing happens in sorts of let's say an equal weight also. An equal weight strategy is also a smart beta strategy. हर stock को similar weight मिलता है. And again, right thing, ask yourself कि equality कब अच्छा करेगा. It means equality को अच्छा करने के लिए smaller stocks should do well. Smaller stock will do well when there is a bull run, a broad market rally. And again, if you look at in longer term, you'll typically see that since in India we are living in a stock market which has been in a good run for last multiple decades, apart from few hiccups here and few black swan events, you will see that even equal rate 7-year performance, 5-year performance does quite well. On the low vol, you will find that alpha is not so much, or rather outperformance is not so much. So if you look at, for example, 7-year data, it's 14.7% versus 13.9, hardly 0.8% outperformance, right? But that is not the intent of the product. Intent of the product is to have less risk also. And you'll see that over a period of time, low vol has lesser volatility. So it is suited for a completely different uh, uh, investment objective. So if you want market level returns with lesser risk, low vol in the long term may provide that. If you're looking at high risk, high reward, alpha in the long run may provide that. Same is true for BSC 200 equal weight. So yeah, so point was that always look at portfolio cyclicality of any smart beta fund, any factor strategy. Understand that and then invest if it aligns with your investment objective. Same thing we have highlighted in the calendar year return, that every product has cyclicality, right? As soon as you move away from uh, products like Nifty 50 or products like Nifty 500, Nifty 500 multi-cap, etc., you are basically adding some amount of incremental risk in your portfolio. Same is true for thematic investing, same is true for smart beta investing. And you can see that alpha, we have highlighted in this column, does well when markets are doing well, and it can have a poor time when markets are either flattish or not doing well. For example, look at 2022, 5% return of Nifty 200 but it gave a return of minus 9% alpha 30. But next 2 years were fantastic. So this sort of data you can see in history also, right? Same is true for other smart beta products also. This is one interesting slide which just talks about the 10-year risk to return. So Nifty 50 is here. From a risk return point of view, this is return, this is risk. But if you look compare it with alpha, just look at return potential, but look at risk also. It is more risky than small cap, more risky than mid cap, but it returns in last 10 years were higher than these two segments also. You can look the same at value also. Value has even higher risk than alpha, and you can look at the return potential also. This is very interesting slide which just talks about how the risk return profile is of smart beta products. This is also one very important slide which just talks about the cyclic talks about uh, sectoral exposure also is very important. For example, alpha or momentum are are sorts of loyal to no one. They will track the sector whichever is doing well. In 2020, it was healthcare because of COVID. Healthcare was doing well in 21 because of entire euphoria around digitalization, around work from home, or etc. IT segment was doing well. AI was a fad. So was fintechs and delivery companies, etc. Your IT, etc. was doing well, so it had higher exposure to IT. Then the conversation shifted towards capital goods, then towards PSUs, etc. And you'll see the sector shifting. So alpha and momentum is always uh, uh, focus on sectors which are doing well, so their exposure changes dramatically. But what doesn't change is the exposure typically at a sectoral level of low vol products. It will always be biased towards in favor of FMCGs, healthcare, a couple of large cap companies which have shown more sturdiness, so they have less churn also, and they are somewhat biased also towards certain segments. So is quality. Quality will see is always have high exposure towards segments which are less capital intensive. So you'll see IT में सबसे ज़्यादा exposure होगा, FMCG में सबसे ज़्यादा exposure होगा. You will see it having a very less exposure towards financial services. See, just 2% compared to 37% of the market, which is huge deviation. So you should also look at all these factors before investing. So two products from smart beta which we are still suggesting is alpha 30. We have both ETF as well as fund of fund, right? Like I mentioned, it is still at a 15% price correction from its all-time high. If you look at data, fantastic performance in the long run. I think if anyone is willing to invest with an horizon of 5 years or so, you can look at investment in Alpha 30 ETF or Alpha 30 fund of fund. Now, if market does well, let's say next 1 year, next 2 year, or next 2.5 year market does great return, lot of returns can be front loaded also, right? For example, like I mentioned that alpha does well when market is doing well. Why I'm saying 5-7 years is because typical market cycle 5 से 7 साल की होती है, टिपिकली 7 साल की होती है. सो अगर आप एक मार्केट साइकिल में इफ यू आर एबल टू सी दैट द जर्नी व्हेन मार्केट्स आर डूइंग अ गुड sorts of a bullish phase, then you have sorts of done well in your alpha investments, because that is when this product does quite well in that bullish phase. Now, bullish phase can be in next 2 years also. It can probably be in 26, 27, or 27, 28. Whenever that is when your investments will hopefully sorts of pay out reasonably well. So alpha is one thing. If you look again, like I was mentioning, talked about 7 year returns and 5 year returns, and it does better than momentum also. So I like personally alpha 30 more than momentum 30, because here the portfolio is getting reviewed on a quarterly basis. Even on a rolling return basis, 7 year rolling return is 17.1%, substantially higher than mid cap, substantially higher than Nifty 50 also. This is how index changes. I've already talked about it that alpha is loyal to no one. It tracks segments which are doing well. Somewhere it will be shifted towards large cap, somewhere sometimes towards mid cap. Same is true for sectoral exposures also. Last product which we'll suggest is mid and small cap momentum quality 100 ETF and fund of fund. This is India's only product which invests in mid cap and small cap only. 50 mid cap stocks are selected and 50 small cap stocks are selected based on metrics which I mentioned, based on liquidity. Then we look at quality, return on equity, low EPS variability, low debt equity ratio, etc. Then we look at 6-month and 12-month risk adjusted performance. And then we select 50 mid cap stocks and 50 small cap stocks. Typical weightage of 50 mid cap stocks is roughly around 70-75%. And small cap is around 25-30%. So it's a 75-25 split or 70-30 split in a weightage point of view. And this, I think, is a uh, uh, good product because it just takes away the conversation कि अब अभी mid cap में डालना है कि small cap में डालना है, right? This is one product which gives you that 50 mid cap and 50 small cap stocks, and just remove that issue, because if you look at longer horizon, mid cap has done well. If you look at shorter horizon, small cap has done well. So and we have created something which looks at both at us at any given point in time. We look at this using both momentum and quality, because quality is sturdy, momentum is something which tries to target higher returns. It can have higher drawdown, but then hopefully quality as a parameter protects us from having a deeper drawdown. So this is a very good multi-factor product using momentum and quality are two contra factors to pick out 50 mid cap and 50 small cap stocks. If you look at longest term, for example, 7-year rolling return, this is mean. On an average, it has given 20% return, whereas mid and small cap, which is the benchmark, has given 14% return. So around 6% CAGR outperformance if you're looking at a 7-year rolling return. If you're looking at a 5-year rolling return, number almost remains the same, 20.6% versus 14.9%. From a CAGR point of view, also just look at 7-year data, 19.2% CAGR return. If you look at mid and small cap, 17.9, mid cap 18.9, and small cap 16.1. So this is, I think, a very good combination. And if somebody is looking at investment in mid and small cap space, this is one product which I'll highly recommend. Looks good. Also, very quickly, I think these are the rolling returns. Again, I'll just highlight 5-year rolling return of Alpha 30, which is roughly around 17%, and mid and small cap is around 20.6% or so. One thing also which people can look at is SIP investment. I think that is something which can also be explored if you're not willing, or if you're not sort of confident of timing the market, and believe me, that is really difficult. I think SIP in smart beta indices makes a lot of sense. See, whichever product is more volatile, segment is more volatile, वहाँ पे SIP का relative performance भी अच्छा रहेगा, because you end up uh, aggregating your SIP end up aggregating certain units when chips are down, when the correction is taking place. So your average cost of acquisition goes down. So volatile products typically on a relative basis, SIP does good. So let's look at, let's say, a 5-year or 7-year SIP for Alpha. On an average, it is 18.9% SIP returns. Max is 31%, minimum is 4.3%. So there have been phases when 7 साल की SIP ने 31% रिटर्न भी दिया है, on an average almost 19% return दिया है. Mid and small cap, if you're looking at, average is around 21%, max is around 31%, min is around 6%. That is true also for, let's say, a Nifty 50 or even a mid cap SIP also. This is pure, right? If you're looking at average, mid cap ka average is around 16.8%, low is around 2.3% for a 7-year SIP. So just look on a comparable basis also. I think SIP makes a lot of sense when you are looking for investment in smart beta products also. So yeah, so that's it from me. And these are products which we wanted to highlight. So first one was multi-cap. That's one core option which you can evaluate right now. If you don't want to invest in ETF, you can look at our total market uh, index fund, which gives you exposure to 750 stocks. Uh, on the theme side, we really like Nifty India New Age Consumption ETF. There's fund of fund option also if you don't want to buy ETFs. And then on the smart beta, continuing to suggest Alpha 30 ETF and fund of fund. You can pick either medium and mid and small cap momentum quality ETF or fund of fund. And on the commodity side, right now, we are suggesting silver, where we feel that silver probably can do uh, good in terms of returns point of view. Having said that, I think with what is happening globally right now, do invest in gold from an asset allocation perspective. So that's it from me. I'll be taking few questions. So if you have any questions, please post them. So there's one question. It is actually it's on multi-cap with an average of open. So it is good to know more on multi-cap units. Yeah. So someone is asking about multi-cap and mid and small cap quality. See, what I'll say is that it's if you're looking for core allocation, bit of a safer investment, invest in multi-cap. uh, do it in a staggered manner. Like, for example, we are back at the valuations where we are not very comfortable with the market, right? Earnings have disappointed. They have not been sorts of looking at uh, com- earnings for next year. The projections are also not sort of very promising. So if you're looking at a core allocation, you can look at multi-cap, do it in a staggered manner. uh, if you're looking for something where you are able to take more risk and invest for 5 year horizon or so, then only you can look at mid and small cap momentum quality. There is one question: gold has outperformed silver more often than not. Should we not? Should we invest silver at all if you have exposure? That's a very good question, Sunil. So I'm not saying that everyone should invest in silver. Some people are looking at taking a tactical call, right? See, ETFs are getting popular because you can take those tactical call. आप आज इंट्राडे आओ, 10 दिन बाद इंट्राडे बेच दो. So for those sort of people, I think silver can be a good tactical uh, addition in their portfolio. Having said that, nothing. I mean, like I talked a lot, the fact that it should not be equated with investment in gold. Gold is completely different, and gold should always find space in your portfolio. If anyone wants to choose two ETFs from Mirai Basket, which are good for the long term, if you ask me, I'll suggest mid and small cap momentum quality. That is one I'll suggest, and the second, like I mentioned, I suggest multi cap from a long term point of view. What do you think the stimulus given by government to retail recommended on say report gold buy? You may start. I think there's a question by Aman. I think he's asking about investor behavior in a manner that will, whether he will do saving or a SIP or a gold buying. I think that is why, Aman, I was suggesting looking at our new age consumption also, because in a way it takes exposure to all those segments, right? Discretionary mein, if you're looking for spending, it's captured. If you're looking for investing, that is captured. If you're looking for travel, that is captured. Uh, it's difficult to look at uh, and comment what people will do when the additional saving happens because of stimulus by the government. If I'll have to sort of say, I'll say that uh, uh, I think proportion of discretionary spending will increase, and that is a trend which is happening. So that is nothing to mean that कि लोग इन्वेस्ट ज़्यादा नहीं करेंगे. आई थिंक लोग इन्वेस्ट भी करेंगे एंड लोग स्पेंड भी करेंगे, एंड दैट इज समथिंग विच विल सी ओवर अ पीरियड ऑफ टाइम happening. Why is mid and small cap momentum quality not doing well for past few months? Is below average. Yeah, I'll so Dave Golcha, I'll come to your question in the end. Uh, so Fang ETF, there's one question. Fang ETF, is it a good time to invest now? Uh, so probably not at the premium which they are trading right now. They're still trading at a 20% premium in the market. So at those premium, I will not suggest to invest in Fang at these levels. How are alpha and momentum different? So momentum and alpha from a idea point of view are same कि भागते हुए stocks में invest करना है. Alpha, what Alpha does, it reviews the portfolio on a quarterly basis. Momentum reviews the portfolio on a semi-annual basis. So I like Alpha more because review is more frequent. And second is Alpha, whichever stock is doing well will get the higher weightage. Momentum mein, it looks at both performance and market cap. So for example, if we are selecting, and this is an example, ICICI Bank and a PNB. In Alpha, if PNB is doing well, PNB will have a higher weightage. In Momentum, typically ICICI will have a higher weightage because ICICI market cap is significantly higher than PNB, even if PNB is doing well. Uh, so if you're asking for a portfolio of ETF for someone who is doing well from for a 10-year horizon, wow. So again, multi-cap is something which I will use as a base, right? And then two things I'll add is alpha 30 and mid and small cap momentum quality. As a sort of a satellite allocation. My core will be multi cap. Two other products will be sorts of alpha 30 and where I'll do a smaller allocation, mid and small cap more than that, and larger allocation to multi cap 50, 25, 25 ETF. From a theme point of view, hmm, I'll probably do a smallish allocation in new age consumption and manufacturing ETF. But if you want to keep it simple, just look at multi cap, uh, then mid and small, and then alpha. So there's no scheme which provides exposure to crypto. That is not allowed by SEBI India right now. And yeah, if you have invested in Fang, then hold on to it as of now. Don't invest right now at a 15-20% premium. Yeah, so we'll do a webinar on international ETF very soon in coming weeks. If we invest in alpha, is it diversified? No, alpha is not diversified. So like I mentioned, it is a high risk product. So you should invest accordingly, right? Invest quantum where you are able to take risk and are able to sorts of wither a drawdown also. So alpha should not be sorts of equated to investing in a large cap fund or even a mid cap fund or a Nifty 50 ETF. So look, please be aware of about that difference between alpha and alpha 50. So alpha 50 um looks at I think I'm just trying to figure out a better way to say it. It looks at top 300 stocks uh, by market cap and liquidity, if I'm not wrong. So you'll have in the selection universe, you have large cap stocks, mid cap stocks, as well as small cap stocks also. Right. So, and from that 50 stocks are selected, whereas in Alpha 30, we are only looking at large and 100 mid cap stocks, and that too जिसमें FNO है, वहां पे FNO की कंडीशन नहीं है. So here we are looking at large and mid cap stocks in 200 space जिसमें FNO है. So eligible universe is only 170 stocks. वहां पे they are looking at top 300 stocks in terms of market cap and liquidity. I like our Alpha 30 because since there is an FNO, the issue of liquidity issue is not there because alpha में churn बहुत होता है. We'll have to sell lot of stocks and buy lot of stocks on a quarterly basis. So if underlying stock की liquidity अच्छी नहीं है, and then the fund can struggle, and that is why we have chosen Nifty 200 Alpha 30, where only FNO stocks are eligible, because then I don't have the headache of liquidity, because typically FNO stocks में liquidity is reasonably good. Yeah, so we are going to launch a small case of Mirai really soon. We are already working on it. So thank you for that question, Amita. Yeah, Dashrat Malul asking, can I invest in Hang Seng ETF now? I like Hang Seng ETF, but my problem is the premium. So I'll be cautious about the 15% premium. If you are able to buy it at a much lower premium or around INAV, that is something which you can explore. Otherwise, there is one more fund on China which is open right now. You can buy a different AMC. You can probably explore that. No, there is no ETF on Nifty SME because SEBI, I think, does not allow us to do any product on the SME segment. Now, let me. There was one question on mid and small cap, so let me just quickly go back and highlight the performance also. Yeah. So see what has happened in mid and small cap, and that is why हम लोग rolling returns मैंने नीचे दिखाया है, because quality as a factor has not done well in last 2-3 years. So anything जहाँ पे आप quality add करते हो, वहाँ पे आपको sorts of has not done well, because value has done well relatively, your momentum has done well. So जहाँ पे quality add करते हैं, but फिर भी हमने quality as a factor add किया हुआ है because हमको वो sturdiness चाहिए थी, right? So see how quality has helped in last 3 months. It has given a 21% return compared to mid cap of 19%. So in near term, very near term, it has in fact outperformed the mid cap 150. राइट हम जस्ट इनफैक्ट मिड एंड स्मॉल कैप के आपके बेंचमार्क को भी आउट परफॉर्म किया हुआ है. बट हाँ, यहाँ पे अगर आप 2 year or 3 year data देखेंगे, that is because quality as a factor has not done well, and that is why we presented this rolling return, because it's important to obviously look at rolling return also, so that आपकी वो point to point की biasness चली जाती है. You're not looking at a data which is as on date ending, and hence it gets biased because of the as on date numbers. But if you look at rolling returns, if you look even a 3 year rolling return, 20% versus 15%, 5 year 20% versus 15%, again 10 year 20% versus 15.2%. So I think data comes out really well, and I think quality is something uh, which do well from now on, or soon. So I think no sorts of stress on the fact that this particular product, mid and small cap, has quality exposure. I think it just gives you that relatively downside protection also, or rather ensures that there's no factor biasness or too much of factor cyclicality. I think there's one question of, is it right time to invest in gold and silver via ETF now? I think yes, you can see, you can look at staggered investments in both gold and silver. Keep allocation towards gold. So it depends how much gold you already have. So, but if you're looking, let's assume you don't have any gold exposure, then obviously allocation towards gold should be higher compared to silver. Having said that, our view on silver right now is more bullish, but gold serve its own purpose in any investor's portfolio. Gold going forward will not give a return which it has given in last 1 2 year, right? It has run up quite a lot. But having said that, gold, you never know what is going to happen in next 6 months or a year. So gold is obviously an essential part of your portfolio. So do it in a invest it in a staggered manner. Yeah, so I think I've taken most of the questions. So thank you everyone for joining this webinar. I hope I was able to provide some clarification on the couple of products which we have discussed. And I've hopefully I've taken questions which sorts of resolved any doubts which you had. If not, please reach out to us via any social media handle, and I'll see you next month again uh, on this topic. We will be discussing about the ETFs which are under spotlight for investments. Thank you so much. Have a great day ahead, and please take care.